Welcome to the Velocity Investment Partners Wealth Management Conference Call for our 2026 Market Outlook. Thank you everyone for joining us on the call today. You have myself, Brianne Gardner, and my business partner, John McLean, Senior Portfolio Manager here.
And we just wanted to take a step back from the headlines, discuss the macro backdrop, what opportunities and risks we see, and discuss how we are positioning portfolios for the year ahead.
I think what is important and what we've seen coming off the back of a strong 2025 is that the markets have become a little bit more selective. And we think that theme is going to continue through 2026. Fundamentals of businesses and companies do extremely matter now, and expectations are high across the board. We do think and see, based on our data, that we are in more of a late cycle in the business cycle, and those characteristics are showing through. So the dispersion is rising, meaning that not everything goes up together anymore. Last year was a prime example in Canada and the TSX. Materials led aggressively, and in the US, still technology and some of those AI leadership, Mag 7 or Big 5, were still leaders throughout the year. So we still believe this year is going to be focused more on quality and discipline and being active. And this is a great time for us at VIP to showcase our active management. So focusing on that more than broad beta. So disciplined stock picking should really outperform in the year ahead. One thing we wanted to recap, and we see this almost as a reoccurring theme, is the U.S. and global market conditions. So reflecting back on the last 10 years, really we have seen strong returns. And as an investor in the markets, you have seen, in the beginning, it could have been you put something into the market and it's gone up, which is great, but it has been very bumpy ride for people with 4 major corrections going back to 2018. We look back, we saw the trade war that was Trump versus China. The market pulled back about 20%. Then looking at 2020, we saw COVID. Again, the economy shut down, markets sold off 25 to 35%. Then the massive stimulus created rapid recovery. 2022, inflation and rapid rate hikes. We saw that bear market in the stock market, and markets sold off 27%. And then again in 2025, the second trade war under Trump, and markets sold off 21% last year from February till April. So for us, this shows us that the markets drop hard when recession fears rise, but rebounds have been extremely fast and quick because recessions were avoided or short-lived. So that is certainly something to note.
So when we look at the general outlook right now, as Brianne said, we are late cycle, but not at the end of the late cycle. The U.S. economy is where we're going to focus a lot of our attention. We'll talk about Canada and a little bit about international as well. But in the U.S., they've been in a late cycle environment for over a year. And historically, though, this can run, 18 to 36 months or more. But conditions mean that the tide can change quickly if there's a shock to the system. So that's what we have to be careful of. We do think the easy gains are behind us, even though there are still opportunities. And the backdrop is still very positive. But the longer it goes on, the more extra caution it requires. And as Brianne also mentioned, expectations are high, which means that there will be volatility. Meta was rewarded, Microsoft was punished for barely missing the high bar. So there's going to be earning sensitivity. There's going to be sensitivity to economic data. Right now, what we're seeing in the sector leadership, which we'll touch on in a bit, is very consistent with that late cycle environment. Internationally, we believe there's much more runway ahead. And so when we look at what other analysts are projecting for this year, Morgan Stanley, for instance, they expect an okay year. They don't expect it to be what we've experienced over the last 3 years. They expect average high single digits to low teens. The Wall Street consensus is around 9% for the year, but it does widely range. That's where we have also believed that this year is going to be much more average year for everybody. And then the key drivers that we're going to have to focus on is that earnings growth. We're going to have to focus on the liquidity that's being presented to the market and to the economy, the consumer stability. We want to see that retail earnings and people are still out spending, and the rate cuts. We need to see that continue as well.
Yeah, and as John mentioned, and we've discussed late cycle, we are confident and indicators are showing us that, the sector rotation is showing us that, and we do think we've been in this late cycle environment for, a little bit now, quite a while. More of a late cycle than end of cycle, which is important to note. We are still bullish on the markets for at least the next 12, 15 to 18 months, unless the economic data shifts. But again, and historically, we can maintain in a late cycle environment, and that can persist for 2 to 3 more years. So again, why we still are optimistic, at least through 2026 and 2027. Equity markets are still supported by earnings, as John mentioned. Earning expectations are strong, and liquidity is still there. So the sector leadership that was mentioned, tech, utilities, commodities, is really a classic late cycle profile, as well as energy there. And yes, as Morgan Stanley is expecting, an okay year, not as strong as the last 3, but moderating returns and higher disbursement, aka rotation, out of some of the leadership and some of those high-flying stocks that have done extremely well over the past 2 years, to broadening out. Even if we're looking at the S&P 500, index versus the equal weight, we are starting to see the equal weight catch up and actually outperform. So that is showing us quality leadership and broader participation. If we're looking at just the U.S. now, the Fed is in this cutting regimen, right? We have a Fed chair changeover. Powell is rotating out in May, and we have Walsh coming in June, which is going to be supportive for risk assets. So we do see that as a positive for the U.S. stock market. I think there are some fiscal tailwinds, though, looking at tax cuts starting to hit now, which will also allow more spending. Consumer sentiment is a little bit low, but there is room for improvement there. Corporate earnings are holding up, again, tracking that 13% growth for 2026. And even when expectations for GDP and earnings are high, the returns over the next 1 to 2 years, are, yes, a little bit moderate. High single digits, can be double digits, but do not necessarily accelerate when expectations are so high. So we see earnings surprising, actually, on the upside, which is favorable for the stock market. I think, Morgan Stanley stated that in 2022 and 2023, when expectations were low, return potential was much more higher, as we experienced. So our outlook right now is to see, a 9 to 12% in that range for 2026. If things start to change, we could adjust our outlook, but that's what we see, John and I see, for the year ahead.
And the reason that we expect that type of return on the S&P 500, it is, 1, in line with historic average. 2, if earnings are growing at 13%, as Brianne mentioned, and multiples just stay flat, or even if they compress a little bit, 9 to 13 would be right in line with that. So, it feels reasonable to expect that type of return. The biggest risk that we see in late cycle is that if inflation does reaccelerate, the Fed will have to pivot back to either freezing rates and or, at the extreme level, hiking. We don't think that's going to be much of a problem right now, not based on the data we have. But if they provide too much liquidity, that can reignite inflation, and that would be a problem. And historically, half of the bear markets that we've experienced have been triggered by inflation spikes, which lead to recessionary conditions. So that's one of the risks that we have. But it's also an election year, and that has its own dynamics. There's more volatility. You're going to see the White House do what it takes to get Republicans reelected. And that in an election year, which we'll talk a bit more about in a minute, it's not typically a negative year, but because of the uncertainty, there's a lot more volatility, especially for the first 9 months of the year.
Yeah, and you know what? But why we are still optimistic is that the U.S. macro view overall is still positive. You know, John touched on quite a few details there and what our expectations are and, you know, some risks that we see. But the jobs growth is still strong. Unemployment is stable. You know, that does support continued consumer spending, which drives GDP. GDP growth is steady. So again, this looks like avoiding a recession repeatedly for America. Inflation is staying around that 2.9 to 3%. Yes, it's a little bit sticky, and we could see, you know, a slight uptick out of the U.S. But we've always said we would expect to see inflation within a range. Yes, Powell wants inflation to be at that 2%, which we believe he will continue to hold interest rates until he's probably out. And then we'll see cuts the second half of the year for the states. So this is a little bit sticky, but it's not worsening. And I think the Fed forecasts that there are going to be rate cuts, and that is also bullish and supportive for markets. So for us, that's telling us productivity is surging. Even looking at the underlying revenue per employee is at all-time highs. And that is really due to the AI efficiency that we are seeing and the gains in that area across the board.
Now, turning our attention to Canada, we don't see the same type of strength here. Even David Rosenberg, famous economist and market commentator, has said we're on a clear recession watch for 2026. And well, Brianne and I believe that Canada's been on a recession watch for over a year. We're actually amazed that we've sidestepped an official recession at this point. We think that energy and materials have kind of helped stabilize that. But we've had nearly 3% in Bank of Canada rate cuts. And so they've essentially cut the target rate in half, yet the economy is barely responding to that. Our GDP has been, since the cuts have started, we've been basically running at about a 1% growth rate. So that's very, very low on the positive side. The per capita GDP is actually still negative. Manufacturing is already in a recession. When you look at manufacturing, it's down 5% year over year. Exports are now below the 2022 levels, and they're negative year over year thanks to the trade war and the tariffs and everything. Retail sales are actually flat in real terms when you factor out inflation. Residential construction is also flat year over year. Home prices are negative year over year for 10 consecutive months, even with interest rates falling. And so when we look at all of that, you know, we think if this is what 275 basis points of rate cuts get you right now is a 1% growth economy, then more cuts are definitely needed in Canada. And our dollar is actually quite weak, not just compared to the US, but if you compare us to, say, Australia, who is another commodity economy, and they're outperforming. So as much as the Bank of Canada has done already, they haven't done enough yet.
Yeah, exactly, John. And you know what? Canada is treading water. I think we saw Q2 GDP negative, Q3 GDP slightly positive, just over that 0.0 mark. And we are expecting to see Q4 GDP for Canada come in at negative. So just as a reminder, to confirm we are in a recession, we need to see 2 negative quarters of GDP to confirm that. So if we get Q4, which we will be getting soon from Canada, and then Q1 of 2026 is also negative, then we likely will be in a recession. Do we think it's going to be long? No. Do we think it will be mild? Yes. But again, we think Canada will be patient at making any additional rate cuts until probably the second half of the year. There are still additional risks for Canada. If Trump decides to add additional tariffs for us, the USMCA up for renewal, additional tariffs could come there. Plus, weakening dollar as well. All things that we are watching, but this is our last tool in our toolbox. So Bank of Canada needs to be strategic with when and how they do these next cuts. But as John mentioned, we still expect more cuts on the horizon. So the real recession risk is definitely there more than ever now. And I think with that weak currency and manufacturing recession, really do not support the TSX outlook overall. But sectors like materials, which we are overweight, will likely continue to outperform this year. If we are looking at international markets, we do see better value there and more of a catch-up phase and a catch-up trade. So valuations are strong internationally. We have been increasing our exposure there. We had exposure last year, have just added more to our international markets. Global markets are trading at a significant lower multiple than the US. So if we think of the value that we're getting by investing in these international markets and how much upside we are getting, you can really buy the same revenue growth for a lower premium, which is beneficial. International equities their earnings growth is similar to the US, but again, a little bit more discounted. So while you hear about great returns from international last year, much of that was a currency boosted from a falling US dollar, right? I believe, John, from peak to trough, at one point, the US dollar was down about 11%. And then macro tailwinds that we are also seeing for international markets, earlier rate cuts. So looking at Latin America and Europe, commodities are still strong. We see that benefiting emerging markets, especially resource economies like Peru, for example. Inflation stabilizing earlier abroad, looking at other countries, South Korea, India, etc. We have been playing those, trading those a bit over the years, improving PMIs and industrial activity. So again, opportunities that we do see in the international markets. We did see that early sign of leadership shift from the US to international in kind of late 2025, and now we're seeing a little bit of a stronger catch-up dynamic is expected for 2026. So again, we have been increasing there.
And just to reiterate on our positioning, I know Brianne mentioned it, we are increasing our international exposure. We have had some, we were a little cautious at the beginning of it because we didn't know how the tariffs and the trade wars were going to affect some of the international stocks, but it's turned out to be all right. But that catch-up trade is not over yet. So the lower valuations, the lower correlation to the North American equities, we just see better upside for the amount of risk we're going to take, and that runway ahead is going to continue, we believe.
Yeah, and as I mentioned earlier, talking about the new Fed chair, Kevin Warsh, we were a little bit caught off guard. I think most people were, but still exciting for markets. And we did see a short-term rally when the announcement was there, when it did come out that he would be replacing Powell as the new Fed chair. So really why we like Kevin Warsh is that, his credibility, having gone through past cycles, and also inflation discipline. So he is seen as more of a price stability first policymaker. He looks at markets and trusts that he won't let inflation run unchecked. So he's not just going to let the U.S., if it starts upticking, just let that run. He will make the smart strategic decisions and have made those decisions in the past. He also is great at his pro-market communication styles, so prefers a little bit more clear, simpler messaging, less forward guidance, and more focus on fewer policy distortions, which is great. So less micromanaging there overall. He does have, restraint on political influence, which has been front and center through all of this and through the decisions that were made, which I do think is important to keep, the Federal Reserve separate from the U.S. government, and is known for his independence. So markets do prefer predictable, data-driven Fed leadership, and he will give us that, which is great. And I think he won't, John and I are confident that he won't be overreacting. So the nomination barely moved rate cut expectations slightly, but it means that markets see continuity, right? Not regiment's shock. So the tone has shifted, not the policy shock. The committee makes the decisions, though, not one person, and we do think that that is very important to note. Warsh is not a total hawk. And even going back in 2018, he published a Wall Street Journal piece about how the Federal Reserve has raised interest rates too high and too fast, which is important to note of, how he does see the outlook when he does come in office. So again, I think that as Warsh will be the fourth Fed chair that we've analyzed since, kind of being more in this active market participation post 2011, that the conversations around, where he is headed will be positive. And I think when Powell was nominated, he also had a goal to kind of shrink the Fed's balance sheet. And we are seeing a little bit of almost a Powell pivot out of that. So again, that is positive for markets. I think more caution, more volatility ahead, but good for disciplined investors.
And another couple of things that are good about Kevin Warsh is that the big one we see is that he reinforces the inflation credibility. You got Trump out there saying he wants lower rates, and markets want lower rates themselves. The markets tend to climb as rates fall. So all that being equal, that's better. But the Fed only really controls short-term rates. The long-term yields are what matter to the U.S. debt levels, and that's one of the reasons that Trump wants lower rates. It's so that he can borrow more and not have to worry about it. You look at the Bank of Japan, they're borrowing 200% debt to GDP. They're able to do that because their interest rates have been so crazy low. So we need long-term lit rates, the 10-year and the 30-year of the U.S., to come down. Inflation control is going to do that. So Kevin Warsh is probably good for the bond market as well. The other, on that note, liquidity is another positive to neutral support for the market. And the principle behind it is that, fundamentals definitely matter over the long term. But as Druckenmiller has said, liquidity is what moves asset prices in the short term. And what that really means is that markets rise when money is flowing into the system, and they struggle when money's being taken out. And it was worded to me once that think of it like water levels in a lake. High water boats and consider stocks like boats, they float higher. And when the water's low, it's harder for boats to move. So when we look at the picture right now, the water level is okay. It's not amazing, but it's not draining. The Fed is removing money, but it's doing it slowly. The Fed is shrinking its balance sheet through the quantitative tightening, but they're doing it slower, and that's less pressure on the markets. One of last year's big liquidity sources that helped drive markets up higher is basically empty now, so that tailwind isn't going to be helping. But the U.S. Treasury is rebuilding its cash reserves, so the government is topping up its bank account. That temporarily pulls money out of the system.
Yeah, and I think, as John mentioned, with the liquidity, but not all other countries are adding liquidity globally. So if we look at Japan and China, they are injecting money into their financial system. And that helps offset some of this U.S. tightening that we discussed. So we see government spending is still supportive. Fiscal policy means that there's still money flowing out into the economy. And this will keep the overall liquidity backdrop reasonably healthy. So what we see is the bottom line for investors and how we're managing portfolios really going to be the net effect of that is that liquidity is positive to neutral, not negative. And it's not booming like we saw in 2020 to 2022, but there still is enough to support the equities market. Think of this as almost like a neutral to positive situation, not negative. Momentum is supported, even if it's not turbocharged, and this is a constructive environment, just not an all gas, no brake one. Moving on to the midterms and geopolitical landscape, and I think market sensitivity is we have seen a lot of geopolitical noise, geopolitical headlines, certainly have repeatedly triggered short-term volatility. If we reflect back, Trump's tariff threats, his board, he had out 150% to certain people across the board and then started reducing there. talks of pressuring, Greenland, the Venezuela, and the oil, U.S. political instability. We have midterms, shootings, ICE issues. There is a lot of noise out there, and it really comes down to our job to remove the noise and look at the fundamentals of the companies that we are invested in. Are they going to be profitable the next 6, 12, 15 months from now? Are these businesses or sectors going to be impacted by any of this noise? Or is it just going to be short-term movements that we see that can also allow us to tactically use our capital to pick up some stocks that do get dragged down with the noise? Markets do not like uncertainty, right? But not the bad news, but the unknowns. So the what if. Prime example is the midterms. Markets are quite volatile in a midterm election year, as John mentioned, because we need that clarification of what the next election is going to look like. Who is going to be in leadership? Is it going to be a divided government, etc.? The midterm patterns, midterm years are a little bit more bumpy and volatile, but post midterms, 100% of the time, markets are higher 12 months later, every single time. And historically, we have seen the markets up on average, no matter who is in office, an average of 15%. So again, why we are expecting a strong 2026 through to 2027.
One of the other risks that we've been talking to people about, and that has actually been in the headlines off and on for years, is the U.S. debt levels and the risks of those. And we do see that U.S. debt is a very real potential risk 5 to 10 years out. We don't think it's an immediate one. And the big reason is that, U.S. debt to GDP right now, the one metric is just over 100% right now, just on public debt. Total debt is around 120. But you compare that to, say, Greece, who went bankrupt at 170%. But then you got Japan, who's operating at 200% debt to GDP. It all comes down to how much does it cost to maintain that debt. And if rates are low, then you can borrow a lot. So right now, the U.S. borrowing cost is at that 4% level, and it was even higher. It's come down a little bit, not 0 to 1% like Japan. Now, Japan recently just went up to about 2, and that's what caused some headlines recently, because that was a bit of a problem. The reason their rates went up is because there was inflation concerns. New government budget that said, hey, we're going to cut taxes and increase spending, and the market did not like that. So in the U.S., the interest expense right now is the 3rd largest expense. It's behind Social Security and healthcare, but it could become number 1 in 5, 6, 7, 8, 9, 10 years, somewhere in there, if these trends continue. If they continue to live on a credit card, spending an extra $1 trillion a year more than what they're making, that would be a problem, because eventually taxes would have to go up and spending would have to go down, and that would be ultimately negative for the economy. It'd be negative for whoever's in power at that time. And so that is a risk, but not right now. And as Brianne said, we think the next couple of years, we've got some runway ahead of us there.
Yeah, and looking at what sectors, our outlook is for late cycle, utilities, we are seeing still AI-driven demand, and that is continuing to surge, and utilities are benefiting from that. So think data center, electric demand, grid upgrades cycle is the largest in decades, and late cycle, almost defensiveness too, and structural growth. People start piling into the utility sector. Energy, we talked about as well. Oil stabilizing in that $70 to $80 per barrel range. Inventories are tightening. Free cash flow yield is attractive. Materials, we're still optimistic and bullish and overweight that sector. Copper especially focusing, but high on gold and silver prices means good profit margin. So global copper demand is projected to be 50% by 2040. So supply is tight, but we're still structurally bullish on that key theme in the electrification and grid expansion. We still have exposure to technology, have been overweight, but are trimming back our exposure to be in line in market weight. We should continue to do well in that sector. We don't see it going anywhere, but we are aware of valuation. So I think the focus will be on those earning visibility, AI names, not high cash burn names. So need to be strategic here since valuations are so high.
Yeah, and compared to our normal weightings, we are still overweight materials, we're overweight energy, we're overweight financials and healthcare, and tech, as Brianne said, we're trimming that back down. And part of that comes down to valuations and expected returns going forward. So we know that's one of the other risks, because the market is expensive right now. The S&P 500 forward PE is trading at 22 times right now. So the long-term average is about 17. This doesn't mean that that they can't keep going higher. There's a number of factors in there. It just means that volatility is going to be increased when things are that expensive. With the earnings growth estimated to be 13% this year, if there's no multiple expansion and the market only goes up by 9 or 10%, we're naturally going to get a less expensive market. So that is possible that we see prices rise slower than earnings. But just know that the returns, we still expect them to be good, just not as good as the last 3 years.
Yeah, with those return expectations, we have talked about volatility, and we do want to make that clear that we do expect the first half of 2026 to be quite volatile in both directions, though. Again, midterms uncertainty before, but we do have a clear path forward after, and we do tend to see a Q4 rally, geopolitical risk, but only if they're causing economic uncertainty. High valuation still doesn't mean a crash, but means profit taking, and that will mean a bit of larger dip. So even on earnings, we are seeing companies swing if they are missing or beating in either direction, potentially 5 to 15%. And this AI execution risk. So, the bar is quite high. And if they miss, we will see those stock prices will certainly feel it. But again, historically, post-election year, generally strong double digits on average.
Another factor that affects portfolios is the currency. The US dollar has been a little bit supported by higher rates right now and some risk offloads. So we actually expected to get even weaker relative to the Canadian dollar than where it is sitting right today. And we think it'll continue to drop. Brianne mentioned earlier that last year, globally, it dropped on average about 10%, but in some cases it was 11, 12, 13% lower than the year before. We do think that the Canadian dollar is going to be a bit weaker due to domestic macro softness. And if we do start slashing rates, that's also going to be dropping our Canadian dollar down. So that will keep the US dollar at the 136 level that we see right now. The Canadian dollar is not weak enough yet to boost manufacturing, so more rate cuts would help with that. We manage our currency exposure as well as our geographic exposure. So we've hedged currency a few times. Last year we hedged some at 144 and 139. We reduced our US dollar exposure down considerably. We couldn't avoid it all, but we did bring it down a lot. And the long-term Canadian strength will be tied to commodities in the global cycle. So we think any type of weakness will be short. So that's a big part of it. But the hedges help to reduce down some of the foreign exchange drag that we experienced last year.
Yeah, and currency, again, as John mentioned, we expect to see a little bit more weakening, but if we need to make those changes and add more to our US, we will do that. So we're not just looking at asset allocation, sector allocation, and geographic, we are also looking at our currency. With the metals, I'll jump into. So again, looking at the metal sector and the metals overall, copper, gold, silver example, short-term volatility, we have seen, especially a recent sell-off. Huge profits have been made in that sector. People were piling in. Also, we've seen a lot of US dollar swings and Fed headlines and change up there. So that has caused a lot of that volatility. We are seeing, a little bit more of an extreme overbought conditions, but that doesn't mean that we can't continue to see them do well through 2026, and we expect that. We aren't surprised by the overbought conditions, and I think that large, sharp pullback was expected, or if we continue to see some volatility in the sector. Copper, we really like. The long-term demand is solid. We own a huge copper producer and are expanding our exposure here. Gold, again, we have been in gold for quite a while and increased our exposure last year, doubling down and trimming back throughout the year with the volatility and adding again. It is more rate sensitive, policy hedging, which is great. And we do have, as I mentioned, a healthy portion of gold and precious metals in the portfolio, and we are not looking to reduce it, at least at this time. We have been tactical on trading it though. Again, if it runs up, trimming and adding again. So again, our approach and our VIP approach is rebalance when needed, but don't chase something that's, again, super extreme overbought. If we're looking at earnings season, we're in the midst of that right now. We're about 1/3 the way through Q4 of 2025 earnings, and this is the 5th consecutive quarter that we've seen double-digit profit growth, which is great to see. The S&P 500's corporate profits in 2025 was the most profitable year in history, almost 10%, just over 9.8, I believe. And 2026 is expected to be 13% earnings growth, so 13% higher, which is extremely favorable. Companies are beating earnings, but slightly fewer than usual. About 75% of companies are beating profit estimates. Still a strong number. Normally it is closer to 80% though, but expectations are also normally lower. So it's not a weak season, just slightly below the usual beat rate. That can really be attributed to high expectations, analysts and CEOs that have set the bar pretty high, especially coming off 2022 and the correction we got last year. So companies are beating by more than normal. For the companies that are beating estimates, they're beating by about 9%, which is above the long-term average. So fewer beats overall, but bigger beats from the winners. Earnings growth, again, the 5th quarter in a row. We talked about the S&P 500 earnings is strong. And we continue to see the strength that is coming from tech sector. Earnings per share is up about 30%. And the communication services, so think of Meta, Google, et cetera, they are seeing 10% growth. A few of the laggards in earnings or the weakest sectors based on year over year. So far, consumer staples, energy, and healthcare. But again, we expect those to could improve as more companies are reporting. I think investors are really demanding at this point, though, perfection in earnings. Companies with strong numbers can still be punished if they miss even slightly. As John mentioned at the start of the call, thinking of Meta and Microsoft there, they announced big spending. And if they beat both top and bottom, you can see those sell-offs.
Yeah, and even Google today, they beat on top and bottom line, and after hours it was slightly negative because they're planning to invest so much into capex on AI and data centers and that too. So earnings are delivering. They want to see that profits are up and that the return on investment for these, how fast does this spending on AI turn into actual earnings? And so it really means that execution matters more than potential, especially in late cycle, in a late cycle environment. So again, base case right now for us, base case is that earnings grow next year by 13%, multiples are flat, and we get 9 to 13%. But we are also of the mind that if there's mild multiple compression, or if there's some more, maybe some economic boost to things, that we could see that multiples actually expand a little bit more. So, but we don't expect it to be the last 3 years all over again.
And I think, again, looking at those expectations and where things are, really our strategy outlook for 2026 and how we are positioning our portfolios is, yes, we're staying invested. Yes, we're still bullish, a little bit cautious on volatility. We are remaining invested, but being selective on where the companies we are investing in. Cash, we have raised some cash. We have currently across the portfolios anywhere between 8 to 12% of this dry powder because we are expecting to see some of these sell-offs as we've been talking about. And we are both, though, buyers and sellers. There are some stocks and sectors that are already down 10 to 20% from the peak. Those can be good buys. Some stocks are still overbought and good profit-taking time. So we are looking at high-quality bias, as we mentioned, companies with pricing power, durable cash flows, and even tech, utilities, copper are balancing out our positioning. So we have been increasing international to reiterate, wait for valuation benefits where we see more upside, and diversifying our portfolios across the board. We have added more to our low volatility international component and expanding it that way. We will use volatility that we do see to upgrade the portfolio into the companies that we want to be positioned for the year ahead. If our low vol positions only pull back 5% and we see a good deal on the stock market that is down 20, we can rotate into that to capture the rebound. Again, we are active managers. We will make tactical decisions. We always have a plan A and a plan B. And we have the portfolios positioned in the sectors that we are seeing the most upside to benefit our clients for 2026. We wanted to say thank you to everyone again for joining our 2026 Market Outlook with Velocity Investment Partners. And on behalf of John, myself, and the rest of our team, we wish you all the best, and we will continue to update you throughout the year on how the markets are evolving.